The man who called 2008 just went dark. Michael Burry, the market's canary in the coal mine, officially closed his fund while stocks hit all-time highs. Why? Because his final public filing revealed a $1 billion bet against the AI giants and an accusation of systemic fraud. He's gone, but the math... The Canary just died. November 25th, 2025. That is the date Michael Burry's Scion Asset Management officially terminated its SEC registration. This is not just another fund closing its doors. This is the man who made billions predicting the 2008 collapse, the one who saw through the subprime mortgage fraud when everyone else was blind, walking away from the game entirely. And he's doing it right as the markets are hitting all-time highs. You need to understand the gravity of this. On October 27th, Burry told his investors, and I quote, "My estimation of value in securities is not now and has not been for some time in sync with the markets." The man who correctly predicted the biggest financial crisis in our lifetime is telling us the math simply doesn't work anymore. He is saying unequivocally that reality and market prices have completely disconnected. But here's what should truly make your blood run cold. Burry is converting Scion Asset Management to a family office structure. What does that mean for you? It means no more public reporting requirements. After November, we will not see his positions. He is going dark. The market's canary in the coal mine, the one voice willing to call out the systemic manipulation, is now silent to the public. He is removing his signals precisely when those signals are most desperately needed. Look at his last public filings from the third quarter of 2025. This is where he left us his final chilling message. He was holding $912 million in put options against Palantir. He also had $186 million in puts against NVIDIA. These aren't short-term trades, people. His positions extend all the way to 2026 and 2027. This isn't a bet on a minor correction. It's a declaration that he believes a massive, prolonged collapse is coming. And he's not just betting, he's accusing. Burry has publicly claimed that tech companies are actively fudging depreciation schedules on their AI infrastructure to artificially inflate earnings. Think about that for a second. That is not market commentary. That is an accusation of systemic accounting manipulation across the entire tech sector, the very sector driving this current market euphoria. If Burry is right, the earnings justifying these astronomical valuations are essentially fraudulent, just like the mortgage securities that looked safe in 2007 until someone looked at the loan quality underneath. Now, some optimists will tell you, Jordan, this time is different. AI is a true paradigm shift, comparable to electricity or the internet. This extraordinary growth is justified. And yes, AI is transformative, but even paradigm shifts can fuel unsustainable manias built on speculative bubbles, not sound fundamentals. Look at the dot-com era. The internet was revolutionary, but pets.com with no profit was not worth billions. Burry's thesis, backed by his track record and now his withdrawal from public view, argues that the current prices, detached from manipulated earnings, are simply mathematically impossible to sustain. It's the fundamentals that matter, and he's saying they're rotten. This is only the second time in Burry's career that he has voluntarily closed his fund while markets were still rising. The first time? 2008, right before the financial system nearly imploded. Back then, he made his legendary bet against subprime mortgages, returned 489% in 2007, personally pocketed over $100 million, then closed shop just as the housing market reached its peak. The pattern, my friends, is unmistakable. So, what does this mean for your money? For your 401k, your pension fund, your college savings? We can't all buy $912 million in put options like Burry, but we can learn from his actions. First, review the tech allocation in your portfolio. Are you overexposed to these magnificent 7 stocks, which now collectively exceed $15 trillion in market capitalization? That's larger than the entire economies of China or the European Union. Second, consider increasing your allocation to cash or government bonds. These are the life rafts when the bubble finally pops. And third, implement a gradual exit strategy. Dollar cost averaging out of overvalued assets can protect you from the sharp, sudden drops that always follow these manias. The smart money, the insiders, they're already positioning defensively. But this isn't the first time a master investor has abandoned a rising market. And every time it happens, the same thing follows: a catastrophic collapse. The pattern is undeniable. The Clockwork Collapse. I'm Jordan Blake. I've spent over 10 years researching the mechanics of financial crises and market bubbles. I'm going to be walking you through exactly how this situation impacts your money, and what I'm seeing in Michael Burry's latest move is a pattern I haven't seen repeat with such alarming precision since 2008. You need to understand this. Legendary investors abandoning the market isn't just a coincidence. It's the most reliable crash indicator in financial history. Every single time a master investor has walked away, saying the math doesn't work anymore, a devastating collapse has followed within 18 months. This isn't theoretical. This is the Clockwork Collapse, repeating with mathematical precision. Look at this pattern. In 1929, Jesse Livermore was the greatest trader of his era. The man made $3 million shorting the 1907 panic, a sum that could buy you half of Manhattan back then. By September 1929, while everyone else was celebrating the Roaring '20s, Livermore quietly closed all his long positions. He then started betting against the market. His associates thought he'd lost his mind. The Dow had tripled since 1924. Everyone was getting rich, but Livermore told anyone who would listen that the market had become artificial and was mathematically doomed to collapse. He wasn't making emotional predictions. He was reading the impossible math of stock prices completely divorced from company earnings. October 24, 1929, the market crashed. By 1932, it had fallen 89% from its peak. Livermore made $100 million shorting that collapse, equivalent to about $1.5 billion in today's money. While millions of Americans lost everything, the man who recognized the pattern early walked away with generational wealth. Fast forward to March 2000, we see the exact same pattern playing out. Julian Robertson, who ran Tiger Management, had generated 31% annual returns for 20 years, one of the greatest track records in Wall Street history. His fund managed $6 billion, and institutional investors fought for allocation spots. But in March 2000, Robertson shocked the financial world by shutting down Tiger Management entirely. His letter to investors was brutal in its honesty. The current technology, internet, and telecom craze bears no resemblance to rational investing. He couldn't compete with the mania because he refused to abandon fundamental analysis for speculation. The financial media destroyed him. CNBC called him a dinosaur. Tech executives mocked his old-fashioned thinking. Investors pulled billions from value funds to chase internet stocks that had no revenue, let alone profits. 1 month later, the Nasdaq peaked at 5,048. By October 2002, it had crashed to 1,114, a 78% collapse that wiped out $5 trillion in market value. Robertson was right. He was just 1 month early. Now, let's talk about Michael Burry's first rodeo. From 2005 to 2006, while housing prices soared and banks handed out ninja loans, no income, no job, no assets, like candy, Burry was quietly buying credit default swaps on subprime mortgage securities. His investors revolted. They tried to pull their money out, claiming he'd lost his analytical edge. The financial establishment treated him like a pariah. Bank executives called him delusional. Government officials assured Americans that subprime lending was expanding home ownership opportunities. Even his own investors sued him to get their money back. But Burry had done the math. He'd read the mortgage documents, analyzed the loan quality, and realized the entire housing market was built on fraudulent lending practices. In 2007, his fund returned 489%. He personally made over $100 million. Then he closed Scion Asset Management while banks were still pretending everything was fine. 6 months later, Lehman Brothers collapsed, and our entire financial system nearly imploded with it. The man everyone called crazy had been the only one telling the truth. This pattern extends beyond individual investors to institutional fund managers as well. When legendary value investors can't find profitable opportunities, it signals that prices have completely disconnected from underlying economic reality. Markets operate on two forces, fundamentals and momentum. When momentum dominates completely, the smartest money recognizes that mathematical analysis becomes useless and exits the game entirely. Every crash begins the same way. Asset prices rise beyond any reasonable valuation. Smart money starts selling while dumb money keeps buying. Eventually, the gap between price and value becomes so extreme that even minimal selling pressure triggers a cascade of forced liquidations. The tragedy is that retail investors never see it coming. They're always the last to buy at the top and the first to panic at the bottom. When Livermore warned about 1929, individual investors ignored him and lost everything. When Robertson warned about 2000, day traders mocked him and got wiped out. When Burry warned about 2008, homeowners called him unpatriotic and lost their houses. Today, Michael Burry is closing his fund for the second time in his career, using almost identical language to describe market conditions. On October 27, 2025, he told his investors that his estimation of value in securities is not now and has not been for some time in sync with the markets. The math doesn't work anymore. Now, the optimists will tell you that AI is a true paradigm shift, comparable to electricity or the internet, which justifies this extraordinary growth and these unprecedented valuations. They say this time is different, but the underlying mechanism remains exactly the same. Easy money from the Federal Reserve creates artificial demand. Prices disconnect from reality, and the smartest investors recognize the mathematical impossibility of the situation and walk away. Burry's public claims of tech companies fudging depreciation schedules on their AI infrastructure to artificially inflate earnings aren't just market commentary. That's an accusation of systematic accounting manipulation across the entire tech sector. That's not the future, that's fraud disguised as innovation. And listen to this critical detail. After November 2025, Michael Burry is converting to a family office structure. This means no more public reporting requirements. He's going dark, effectively taking the market's canary in the coal mine away from the public. We will no longer see his positions. He's taking his intelligence and his analysis completely off the board. This isn't just history repeating itself. Burry left a breadcrumb trail in his final SEC filings, a multi-billion-dollar bet against the one sector everyone believes is invincible. The $1 billion against tomorrow. $912 million. That's the staggering sum Michael Burry, the man who called 2008, had riding against one company, Palantir, when he slammed the door on his public fund. This isn't just an investment. This isn't a trade. This is a declaration of war on what he sees as the biggest fraud of our lifetime, the AI bubble. You need to understand what Burry just did. On November 10th, 2025, Scion Asset Management, his hedge fund, officially terminated its SEC registration. He's going dark. The canary in the coal mine is being withdrawn from public view, right when the market hits dizzying new highs. This isn't the act of a man retreating. This is the act of a man who has made his final massive bets and is now hunkering down for the inevitable fallout. He is removing our ability to track his moves, making his final warning impossible to ignore. His last public filing from the third quarter of 2025 reveals everything. He held $912 million in put options against Palantir, and he held another $186 million in put options against NVIDIA. These aren't short-term plays either. These positions extend all the way to 2027, signaling a deep conviction that this correction will be both massive and prolonged. Now, why these companies? Why this scale of a bet? Because Burry believes these tech giants are built on a foundation of systemic accounting fraud. He's publicly claimed, with the weight of his track record, that tech companies are fudging depreciation schedules on their AI server infrastructure to artificially inflate their earnings. Think about that. This isn't just a bearish outlook. This is an accusation of widespread manipulation. Companies are spending billions on expensive AI hardware, but instead of recognizing those costs realistically, they're spreading them out over unrealistically long timeframes. Why? To make their quarterly profits look better than they actually are, to justify the astronomical stock prices you see every day. Let's look at Palantir, for example, the company Burry bet $912 million against. It trades at over 300 times earnings. You heard that right, 300 times earnings. The historical market average? It's typically between 15 and 20. The math doesn't work. You are paying $300 for every single dollar of profit that company generates annually. At that rate, it would take 3 centuries for your investment to pay for itself through earnings alone. That's not investing, that's pure speculation, a blind gamble that some other buyer will be even more delusional tomorrow. This is exactly the kind of mathematical impossibility that Burry identified in the subprime mortgage market in 2007. He did the math then, and he's doing it now. And it's not just Palantir. NVIDIA's market capitalization recently hit $3 trillion. Let that sink in. $3 trillion. That's larger than the entire stock market of the United Kingdom. And Burry is holding $186 million in puts against them, positions that extend for years. He believes the entire AI chip revolution is built on the same kind of accounting manipulation. Now, I hear the optimists. I know what they say. They argue that AI is a true paradigm shift, comparable to electricity or the internet itself. They claim this extraordinary growth is justified because this time is different, that the sheer potential of artificial intelligence is boundless and will redefine every industry. But that narrative is precisely what Burry and history tell us is a siren song for disaster. We heard this time is different in 2000, when companies with no revenue traded for billions because the internet changes everything. Julian Robertson, another legend, shut down his fund then, saying he couldn't compete with the mania. He was right. The Nasdaq crashed 78%. We heard it again in 2007, when housing prices never went down because real estate always appreciates. Michael Burry saw through that fraud too. The math, my friends, never lies. And the math right now is screaming danger. So, what does this mean for you? For your 401k? Your pension? We can't all buy put options like Burry, but we can learn from his actions. First, review the tech allocation in your portfolio. Are you overexposed to these highly speculative, high price-to-earnings stocks? Second, consider increasing your allocation to safer assets, cash, government bonds. They may not offer thrilling returns, but they offer safety when the storm hits. Third, implement a gradual exit strategy. Consider dollar cost averaging out of some of these positions rather than waiting for the cliff edge. Because this manipulation isn't happening in a vacuum. It's being enabled by the same entity that fueled the 2008 housing crisis, and their fingerprints are all over this bubble. The Federal Reserve's trap. $15 trillion. That's the staggering, incomprehensible market capitalization of the magnificent 7 tech stocks right now. $15 trillion, more than the entire economic output of China, larger than the entire European Union. 7 companies are valued higher than the productivity of billions of people. You need to understand, this isn't innovation. This is the Federal Reserve's trap. Look at this. Just like from 2005 to 2007, your Federal Reserve has flooded our financial system with cheap money. They printed it, they handed it out, they created an easy credit environment that doesn't foster value. It fuels pure speculation. When borrowing costs nothing, investors and, crucially, your fund managers chase any asset that promises a higher return, regardless of its underlying reality. And right now, that asset is artificial intelligence. This isn't a theory. Michael Burry, the man who called the 2008 collapse, is screaming this from the rooftops by his actions. He just closed his hedge fund, Scion Asset Management, telling investors his estimation of value in securities is not now and has not been for some time in sync with the markets. This isn't just another fund closure. This is the market's canary in the coal mine going dark. After November, Burry is converting to a family office structure, meaning no more public reporting requirements. We won't see his positions anymore. He's removing the public's access to his insights right when markets are hitting all-time highs. He's walking away, saying the math simply doesn't work. What math is he talking about? Let's dissect his last public declarations. Burry was holding $912 million in put options against Palantir and $186 million against NVIDIA. Massive bets stretching to 2026 and 2027 that these AI darlings are mathematically doomed to crash. Think about Palantir. It's trading at over 300 times earnings. The historical market average, 15 to 20. You are paying $300 for every $1 of annual profit. At that rate, your investment would take 3 centuries to pay for itself through earnings alone. That's not investing. That is pure, unadulterated speculation, built on the desperate hope that some other fool will pay an even more ridiculous price tomorrow. And then there's NVIDIA. Its market capitalization has reached $3 trillion. That's bigger than the entire stock market of the United Kingdom. And Burry is publicly accusing tech companies of fudging depreciation schedules on their AI infrastructure to artificially inflate current earnings. What does that mean for you? It means companies are spending billions on hardware, but spreading those costs over unrealistically long periods to make their quarterly profits look better than they actually are. If Burry is right, the earnings justifying these astronomical stock prices are essentially fraudulent, just like the mortgage securities that appeared safe in 2007 because no one looked at the actual loan quality underneath. Now, I hear the optimists. They will tell you, Jordan, you just don't get it. AI is a true paradigm shift, comparable to electricity or the internet. This extraordinary growth is justified. They'll say this time is different. They always say this time is different, but the math never lies, and the math right now is screaming danger. Remember Jesse Livermore in 1929? He saw that the market had become artificial, its prices completely divorced from company earnings. He closed his long positions and made a fortune shorting the collapse. Julian Robertson, the legendary fund manager who ran Tiger Management, shut down his $6 billion fund in March 2000, calling the tech craze no resemblance to rational investing. He couldn't compete with mania because he refused to abandon fundamental analysis for speculation. 1 month later, the Nasdaq peaked and then crashed 78%. This pattern, my friends, is repeating itself. And here's the critical, terrifying piece for every American. Your 401k, your pension fund, your college savings plan, they are all systemically overexposed to these tech stocks. Why? Because fund managers trapped in a performance chase have no choice but to load up on these highly valued assets while the bubble inflates. Meanwhile, who is getting out first? corporate insiders. Executives are exercising their stock options and selling. Venture capital firms are cashing out their stakes. They know the game. They are moving to safety while you, the Main Street investor, are told to buy the dip. The man who made $100 million personally in 2008 by seeing the mathematical impossibility of the housing market is telling us the exact same thing about 2025. These markets have become detached from reality, making rational profit impossible. So, the board is set. The smartest player has walked away. What does this mean for your money? And what is the one move you can make to shield yourself from the inevitable reset? The end of the line. Markets. They lie. Michael Burry, the man who made billions predicting the 2008 collapse, just shut down his hedge fund. Not scaled back, not shifted strategy. He's gone. On November 10th, 2025, Scion Asset Management officially terminated its SEC registration. This isn't just another fund manager riding off into the sunset. This is the architect of The Big Short walking away from the table, declaring the game unplayable. You need to understand the gravity of this. Burry told his investors on October 27th that his estimation of value in securities is not now and has not been for some time in sync with the markets. The math, he says, simply doesn't work anymore. Think about that. The man whose entire career is built on finding hidden value where others see only illusions is saying there's no value left to find. And then he went dark. Burry is converting Scion into a family office structure. That means no more public reporting requirements. After November, we won't see his positions. He's taking the market's canary in the coal mine away from the public. He's telling us something so profound, so terrifying, that he doesn't want to show his hand while the house of cards collapses around everyone else. This isn't the first time he's done this. The first time was 2008, right before our financial system nearly imploded. He made $100 million personally, then closed shop as the housing market reached its peak. The pattern is crystal clear. When smart money can't find value, it's because the market has completely detached from reality. Momentum has replaced math. Now, some will tell you, Jordan, this is different. This is AI. It's a true paradigm shift, comparable to electricity or the internet. This extraordinary growth is justified. But Burry's thesis and history exposes that optimism as a dangerous delusion. The internet and electricity were paradigm shifts, yes, but that didn't stop the dot-com bubble from bursting, wiping out $5 trillion in market value. It didn't stop companies with no revenue from collapsing. This time isn't different. The math always reasserts itself, and the math right now is screaming danger. Look at Burry's last known positions. He was holding $912 million in put options against Palantir and $186 million in puts against NVIDIA, extending all the way to 2026 and 2027. This isn't a short-term trade. It's a declaration of war against the entire artificial intelligence bubble. Palantir is trading at over 300 times earnings, compared to a historical market average of 15 to 20. That means you're paying $300 for every $1 of annual profit. It would take 3 centuries for your investment to pay for itself through earnings alone. That's not investing. That's speculation built on pure hope. And NVIDIA? Its market capitalization has reached $3 trillion, larger than the entire stock market of the United Kingdom. Here's where Burry's accusation gets truly chilling. He publicly claimed tech companies are fudging depreciation schedules on their AI infrastructure to artificially inflate earnings. Translation? They're spending billions on computer hardware, but spreading those costs over unrealistically long periods to make their quarterly profits look better than they actually are. If Burry is right, the earnings justifying these astronomical stock prices are essentially fraudulent, just like the mortgage securities that appeared safe in 2007 because nobody looked at the actual loan quality underneath. This isn't a drill. Burry's exit is a final warning before a systemic collapse. Ignoring it means risking everything. Here is how you prepare. Actionable step 1. Review your portfolio's tech allocation. An S&P 500 index fund is no longer a diversified bet. It's a concentrated wager on a handful of these magnificent 7 tech stocks. These 7 companies now have a combined market capitalization exceeding $15 trillion. Is that truly diversified in your 401k? Are you comfortable with that concentration? Actionable step 2. Consider defensive assets. Cash, physical gold, and short-term treasury bonds become life rafts when these bubbles pop. When the market is driven by pure momentum and the smartest money is exiting, you need places to shelter your capital. These assets won't make you rich in a bull market, but they will save you from ruin in a bear market. Actionable step 3. Implement a gradual exit strategy from overvalued assets. Don't try to time the market perfectly, no one can, but begin to dollar-cost average out of positions that have become mathematically impossible to justify. The insiders, the company executives, the venture capital firms, they are already gone. They've been exercising their stock options and selling into this rally. Don't be the last one out holding the bag when reality finally asserts itself. The math doesn't lie. Michael Burry's move isn't an opinion, it's a calculation. The only question left is whether you'll do your own math before it's too late. Subscribe.